Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to the Australian Retirement Podcast, your finance podcast for all things retirement every Thursday afternoon. I'm here with my co-host, Drew Meredith. Hi, mate. Good to see you.
Good to be here, as always. Beautiful sunny day.
It has turned it on for us, and we are going to take you through some magical stuff. We have been getting a heap of questions about one particular topic, which is around superannuation and tax. Just before I leap into that, if you are listening to this through YouTube or if you're listening to this through your whatever podcast channel, please do give us a like and a subscribe, because that's going to allow this content to get out to more beautiful humans.
And there's nothing we like more than questions.
And we've got a lot about from here, right?
And the funnier question names, the better. And they all have. Please ensure that they are depersonalized or anonymized. We obviously can't provide personal advice, but more questions are better. It helps us make sure we're being helpful, I think, to listeners, rather than just James and I having a chat every Thursday morning.
Oh, great.
So this one's been in the news for several years now, and it's just another one of those complicated number-based changes in legislation. And I think I'd open the question to you is, why do I even use super anymore?
Well, yeah, because the rules are changing, right? The benefits of superannuation are tightening. There's no doubt. So in this particular session, we really want to talk about something which financial advisors refer to as Div 296, which is a tax
always
legislation.
Shorten everything rather than complicated. We make it shorter, which makes it more complicated.
Correct. And what we're talking about practically is the proposal for superannuation to be, or the internal tax rate of superannuation to be increased from 15% to 30% if your super balance is above $3 million. Now, just before you switch off and say, well, this is not for me then because I'm miles away from that, one of the shocking things about this is that it's unindexed. And as we go through this, you might be amazed to learn that this very well this is going to catch a lot of Australians, because even though you might not have that balance right now, if we fast forward 10 or 15 years, the compounding effect of the growth of your super means you may very well be there. And we'll speak to that as we go.
Yeah, can they just leave my super alone? It's like there's a change every year to superannuation. I know a lot of people have probably confused this with Division 293, which has come up at different points in the past. Division 293 is an additional 15% tax that is on your concessional contributions where your income is above $250,000 a year. In a similar way, and that's where I see this angle coming from, Division 296 is almost a means-tested tax where they're adding more tax to people who have more significant balances in superannuation. And we've been in the industry nearing 20 years, a couple less for yourself, hopefully. And it seems
I was
like
writing statements of advice when I was 15.
Yeah, exactly. So. Because you've been in the industry for 2 generations. I forgot about that. I think one of the most interesting things is that I don't think a year goes by without some slight change happening to superannuation. And I can't explain, or I couldn't list a number of comments we get about why do I use superannuation, and the amount of frustration that comes with what the news would say are retrospective changes to taxation law, which means that impact the people who began contributing 20 years ago or 10 years ago or 5 years ago thought that it was going to be tax-free.
Tax-free.
Yeah, and these are things that are now impacting the attractiveness of superannuation. And as I've said and you've said, and I think a lot of people said over and over and over, superannuation, even with this tinkering, will remain by far the best environment to hold your superannuation or your retirement assets in Australia as an Australian.
There'll be certainly some things to do in terms of optimization, but nevertheless, and we'll speak to some of those examples, and we've got some show notes too to support that.
Yeah, of course. And I think maybe the best place to start is, can you explain to me how Division 296 is going to be applied?
Yeah, I can. I actually wouldn't mind. Let's jump back a little bit, if I may. Gather around, children. We're going to talk about like how we've come to be here, because when we started our advisory careers, everything in retirement phase was tax-free. Yeah. And there was no exception to that. There were no caps.
If you could get it into super, you could get it tax-free.
Yeah. And this coincided with this time where you could put $100,000 into superannuation and claim a tax deduction for the full whack.
$1 million in 2007. You could put a fat mill.
Which is a clean, crisp $1 million that is sitting around in coins in your top drawer. All of these, you could put huge amounts into super, and the flow-on was that the assumption was that the money that you put in, once you retired, you'd never pay a dime in tax. And of course, our superannuation system we're past blossoming. It's ballooned into this, tremendous system, which has a huge amount of money in it and growing.
It's probably one of Australia's greatest achievements. I'm not sure is that being too political, but
yeah, I don't feel like I've done too much other than making some voluntary contributions, but I know what you're saying because it's the whole point of superannuation in the first place, the reason it was introduced is identifying that we are going to have this aging population crisis that is not going to get supported sufficiently by a new wave of tax-paying workers. Yeah. And so we can't afford to have millions and millions and millions of people on full government support benefits. We need to find a way to encourage them to save for their own retirement so that they can get to a point where they're financially independent without relying on the government.
And we saw the kind of the struggles of the defined benefit system, which is the government or a company take on the liability of paying pensions to their staff or population. And that's created significant challenges in a lot of parts of the world. And a lot of them look at Australia's self-funded retirement, is essentially what we're doing, with, I think, a lot of respect.
Yeah, agreed.
Regardless of all the changes.
So let's go back, and I'm lucky enough to be able to go back a really long time because both of my parents were financial advisors, and my dad affectionately shared with me about the years at the very beginning when the priority was let's just get people opening super accounts. Yep. And at that point, back in the late 80s, early 90s, when you could voluntarily contribute to super, the deal was unbelievable. It was like you put, I think it was $3,000 into superannuation, and that entire $3,000 you get a tax offset for. Yeah. So basically, you just get all of it back come tax time, and then of course, voila, you had a superannuation account, and there were a huge other number of ancillary benefits to support people to financial benefits, but smaller scale benefits to support people doing it because the view of at the time, the FAIs and the Australian Eagles and these old businesses was, hey, if people contributed money into super, we'll have them for life. Yep. AMP was right at the front of this too. And in many respects, it's been true. How often you sit down with someone that says, I've got a super fund, but I haven't changed it. And I've had them since 1994 or 91.
Mutual was around too. Yeah.
Spot on. Yeah. So some of these policies are super old. And the thinking was, let's encourage people to get money in there. And the promise during that time was always when it goes to retirement, it will be tax-free. And it stayed that way. And it was always a really difficult time, a difficult political issue to try to change that, because telling a huge amount of Australians that your money is going to go from being untaxed to now being taxed, like all of your retirement savings, is political suicide. So how's it done? And that was done. So everything stayed that way from the early 90s all the way up until, 1 July 2017,
I've
right?
blacked reasonable benefit limits out of my head, which a lot of listeners, I'm sure, are aware of. But up until 2019.
Throw the TRBLs away. We're not doing that today.
We're never going to them again.
But yes, until 1 July 2017, the coalition government introduced a scheme which was the transfer balance cap. And
it's like the simplifying super, simple super.
That's right. And what it really meant was just it's time to start taxing superannuation accounts. Yeah. Now, for mine, I'm not big on the idea of having incurring tax at any point, but I did feel that the way that this was done was actually a real masterstroke, because to say from moving forward we're going to tax Australian retirement accounts was going to be incredibly unpopular. Yeah. And the way that they did it, of course, they said, well, this isn't for most Australians. Almost everyone is going to be unaffected here. It's only if your balance is above 1.6 mil. And I think the thinking at the time, if I recall, was that if you have more than 1.6 mil in super, you should be taking $100,000 a year of retirement income, and i.e. you're fine. Yeah. And this was a masterstroke because it allowed for the first time retirement balances to become taxable, and it opened the gates to that being a possibility, and it hadn't been for the previous 20 plus years.
Yeah, and it had barely been touched because for as long as we can remember, the tax rate was 15% accumulation and 0% in pension.
Yeah.
And there was very little else that mattered. A little bit of tax if you took it out before 60, but preservation age and all these things changed to the point that you couldn't really get money out before 60 anyway. Yep. You definitely can't anymore. Mm-hmm. So I think, and it was I think the PR of it, and without creating, I mean, if you tried to do that in the last 3 years, it's probably a lot different. But it was incredibly well managed, and it was hard to say exactly as you said. The government made an assessment of what level of people will be impacted by it, and that a comfortable or reasonably comfortable retirement is something like $80,000 tax-free to $100,000 tax-free, and that's achievable from a balance of 1.6 million. So, and the hope was that it wouldn't impact too much of the vote, as it always is, and that's half the problem. But I don't think we've had a year ever since that didn't involve some kind of tinkering. This is probably the biggest change, I think they're trying the same approach, which is that it won't impact as many people, but you've got some data you'll share at the end. I think that kind of blows that out of the water too. And there's been a lot. All you have to do is Google Division 296 and you'll see the myths, the misconceptions, the impact, why everyone's going to be impacted by it. There's so much media and everything around it.
Agreed. And one of the big things that happened with these transfer balance caps in 2017, critically, is that they were indexed.
Yeah.
And they said it will go up with CPI and it will increase in $100,000
CPI went up 7%.
Yeah, it did.
I didn't see that coming.
But the effect of that is that the $1.6 million transfer balance cap, which is, for simplicity, the amount of money that you can transfer from your accumulation superannuation account, which of course is taxed at 15%, into a pension, which is taxed at 0%. That number, they said from now on, if it's above, if you have a super balance of 2 mil, for instance, then you can only transfer 1.6 into pension, which means that the other 400,000 is going to stay in accumulation and continue to be taxed at 15%. So in essence, it was, if you look at your super more broadly, of course, it was creating a tax for all of that money above.
It was often confused with the total super balance cap as well. So they introduced two caps at the same time. The total super balance cap is the one that determines whether you're eligible for things like if you're able to make further contributions to superannuation or further after-tax contributions to superannuation, and then other superannuation benefits that come out of it as well. That's, I think, something that this is.
For God's sake, let's not do that now.
Yeah, and one of the interesting things about this is because it was, I'm pretty sure it was called the simpler super legislation, but the indexation, and this is where financial advice can be incredibly powerful. The indexation means that everyone now has a different transfer balance cap, that it's actually indexed individually and depending on how much you had room left at certain dates. So it has actually become, it's not like everyone now gets 1.9. It's how much you used before when 1.6 was in to
what date you initially created pension accounts.
It has become, and maybe that's a good takeaway for everyone today. Go log into MyGov if you haven't registered. It can be a process, and check what your transfer balance cap and your total super balance cap is. Just get informed and get used to looking at this.
Great advice. So we now that number's changed from 1.6 mil to 1.9 mil. So from 2017 to 2024, it's gone up by 300,000. And that 300,000 is reflective of the fact that it's indexed, and that means it's going up with CPI to take into account that people's wealth is going to grow. Now, that's the right approach for these sort of policies, because it ensures that it stays in the domain of inverted commas wealthier Australians. And that your average Australian, your average mum and dad are not going to have balances of 1.9 million in super each.
Yeah.
And so very likely they're not going to be affected. Now, from there, so as you pointed out, from 1 July 2017, we've had small incremental legislative changes.
Yeah.
But none of which or most of which have just required a little bit more nous in terms of, from a financial advisory perspective,
Div 293, I think, was one that came. Yep. Or the changing of the threshold for Div 293 is one that came afterwards as well.
Yep. Which, as a reminder, is if you're earning above 250K, then all your super contributions aren't taxed at 15%; they're taxed at 30%.
Yeah.
But this Div 296 is much bigger. So first, can you speak, mate, to what practically happens for Div 296? We still have the position of you can only put 1.9 mil in pension, which means that if you had, say, 5 mil, then that means that 3.1 mil has to stay in accumulation and get taxed at 15%.
Yeah, exactly.
But if this legislation goes through, that's no longer the case, right?
Basically, I mean, you'd assume that is only impactful for people that already have $3 million into superannuation. Sure. But there's data and all the history shows that 60% of your returns actually come during your retirement. So if you start with a reasonable balance, let alone we'll go through contributions, like if you start with a reasonable balance, there's every chance you move above $3 million at some point. Importantly, this is $3 million per person, not per super fund. And that's where a lot of misconception comes through, that you actually have to have more than $3 million in each member account or in your own superannuation account to be taxed, to be caught under this. And once, if you've hit that trigger, and this doesn't, so tax will only apply from 2026, from the end of the 2026 financial year, but the calculation will start from 1 July 2025, is the proposal as we speak at the moment. And essentially, anyone that has a balance over $3 million will be assessed on a higher level of tax for I believe the word is notional earnings. As always, is a more complicated word. So the notional growth or earnings or income that comes from that portion of the portfolio of their superannuation balance over $3 million.
Right. Okay.
I think that was a simple way to.
So if I'm coming back momentarily to a $5 million balance, we've got 1.9
for an individual person.
But for an individual, we've got 1.9 that might hypothetically be tax-free in the pension fund. Then before, the 3.1 is taxable at 15%, but now we would have 1.1 that was taxable in the traditional way, taking us up to 3 million. And then the last 2 million would be taxed in this entirely new way, right?
Prorated, that's right. So, and this is where the complexity comes in, that you've got to prorate the portion of the fund that's over $3 billion and then apply notional or actually unrealised gains and any other returns within the fund, and then apply a tax rate after multiplying the three of them together. So the portion of your fund...
Please stay with us.
The portion of your fund that is over $3 billion, let's say in this case, as we were saying, it should be 40%. Yep, good. I got that right. And let's say a return of 10%, total return of 10% on $5 million is $500,000. 40% of that is $200,000. So what I get 20. So instead of paying 15% tax, as we would have on that portion, we're now paying 30% tax on that portion,
which is meaningful.
It's significant. And then I was looking at, so Class Super is a data provider and supports the preparation of SMSF tax returns. Interestingly, I didn't pre-prepare that case study that we just went through, but they've said there's something like 16,000 members of Class are going to be impacted by this tax change, and the average tax liability based on FY23 results and numbers for each of those is $50,000 per super fund that they deal with.
That's huge.
That's significant, and a lot of them don't have the ability to have. I mean, this is for super funds that for the last 10 years have probably been getting refunds or being at zero tax because they also have large accumulation and pension balances. So it's significant.
It's massive.
Yeah.
Yep. It's massive. Now, and that also noting that research is actually, that's just looking retrospectively at the last 12 months.
Yeah, only FY23.
Yeah. Whereas, as we talked about at the beginning, if because this $3 million cap is not indexed, or at least that's the proposal, because it's not indexed, it's actually going to capture a huge amount of Australians that as their wealth grows, they move into this category. So I'll include this in the show notes, but for some context, when this proposal came out, I put a post out on LinkedIn, which was just running some numbers for a 40-year-old with $200,000 of super balance, not an unreasonable balance for a 40-year-old, 150K of income, again, not unreasonable, and planning on working to age 65, enjoys work and planning to continue to work without any voluntary contributions, and just taking an average long-term rate of return for superannuation, not even investing it in a really aggressive way or anything like that. This person is going to get caught in that web. They've got a 200K balance right now.
That's
and
pretty
get caught.
Standard professional job, basically. I mean, blue collar, white collar, that's basically a pretty standard position to be starting. If you've had the benefit of super guarantee contributions for an extended period of time.
Yeah. And I note, of course, that in reality, any of the tax effective stuff that a lot of these people would continue to do or seek to do in their 50s or 60s, like additional superannuation contributions and so on, if this proposal remains unindexed, in reality, that's going to need more thought now. Yeah, it's because we're walking headfirst into a taxable event in the future years. So I mean, that's very important.
Probably, hopefully you share the view, or I shouldn't say hopefully, but you probably share the view that this is opening up this ability to tax Australians on unrealised capital gains. That means you could be holding, and this is where the biggest concern comes, that a lot of farmers, a lot of business owners, as they're allowed to, have put their farms or their business property into their SMSF, and this opens up the risk that you're now going to be taxed on before you even sell these assets. It's like saying if you own an investment property and it's gone up 20% according to the rates notice, you have to pay the tax office that tax on that 20% gain now, even though you haven't sold it.
And you don't, which means in a lot of cases, you're not going to have the money to actually make that payment.
Exactly.
Like it's embedded within the property.
That's what, and the concern is that a lot of people will have to sell their properties if this came in the proposed structure. But that just, I mean, obviously it's very difficult to see that being expanded beyond superannuation. But it's a significant shift.
It goes against the fundamental premise of our tax system in the sense that our tax system has always been of the view that when you realise an asset, when you sell it and the funds become available, that's when you should pay capital gains tax.
Every tax system, isn't it? Is there another system in the world that allows taxing on unrealised gains?
That question's way above my pay grade. But
if anyone does know, please send feedback, send questions, any links.
I think that'd just be a statement, but I'd love it anyway. If we think about unrealised gains, that is massive and has a huge implication. And the extension of that is that's probably been one of the biggest reasons that this proposal has been held up, right? Because there's that additional tax to superannuation for that 3 million plus. I can't help but feel that if they didn't have that unrealised gain caveat in there, it probably would have got through already. But that just gives rise to a huge amount of technical complexity around, well, like, do we need to value assets every year now? Yes. What about auditing? What about making sure that assets are valued correctly? How are we going to manage?
How do you value direct property?
And indeed, some stuff is unlisted, for example. So that needs to now be valued on an annual basis as of the 30th of June. We also have the huge complexity around the liquidity of a fund. Consider an investment. Let's take a self-managed superannuation fund, for example, that has 2 investment properties in it. We would be building out an expectation of return over that period and saying, okay, well, every year your tax is going to be significant to take. Like, where's that money going to come from, and how do we get that money out? And oh boy, that's messy.
Yeah, definitely. And I think the key is it doesn't just apply to SMSFs either. It's going to apply to every super fund. And
yes,
I don't even know how that's going to work, but you'll just see slightly lower returns depending on where your superannuation is invested.
Now, to be clear, the reason why they want to take an unrealised approach to this instead of the traditional when you sell it you will pay tax is because they want to protect against people hoarding assets inside the superannuation environment. Yeah. So even if you have a retail superannuation fund, you might have a huge amount of CBA, for example, and you've made great gains on that. You're in no rush to sell it, or you've got an ETF that's done remarkably well. I'm going to hold that. If I sell it, I have to pay tax because I'm above 3 million. So what people could conceivably do is look to release all of the investments initially that have no tax or very little tax until the super balance was below 3 million, at which point they could then sell the high gain positions. And that's a risk. Similarly, people might, for example, actually pay big lump sum pension amounts out of their superannuation environment. They've got 5 mil in super like we were talking about. And so let's get 2 mil out as a one-off pension payment so that now I'm back at 3 and then I can sell that property that has a huge capital gain attached and it's far better. Yeah. So
more planning opportunities.
Yeah, certainly. But Jesus, it's going to be complicated.
So the big question would be exactly kind of what you said there. I've seen a lot of questions and a lot of Q&A about surely we just take all our money out of super now. It's not worth it. What are you seeing? What sort of action are you seeing taken? Are you considering this in advance? And what are the strategies that people have been thinking about or discussing?
Great question. We've been considering this as part of people's advice, but we haven't actually been taking action on these recommendations yet because the way that they're shaped right now, personally, I just can't see how they get through exactly as they are.
And that's always the big one there is that if you feel like you need to take action on the risk that something gets through, but most of the time the best course of action is nothing.
Mm-hmm. I think that it will be really hard to get the unrealised gains part through in particular. I think that's the obvious change. I do feel as though, I think you do too, that 30% tax for $3 million balances or whatever that number is, and increased tax for even higher balances than the transfer balance cap that we talked about earlier. That's coming.
Whether it's some way or another.
Whether it's this year or next year or the year after, like in an environment where Australia needs to collect more tax revenue, that seems like very low hanging fruit that isn't necessarily going to swing marginal voters. So I imagine that is coming, and so of course we're very dialed into what's happening here.
Yep.
But until it at least gets through Parliament, from ours, we're going to stand on the sidelines and watch carefully.
Yeah, for sure. And I mean, the standard things are, as you said, restructuring your superannuation by making kind of withdrawals out of the fund, selling assets and bring forward. A lot of articles are talking about make sure you're aggressively valuing your property. You have to value it every year. It has to be audited every year, but it can be difficult to get a really fair, true value sometimes. And we've got a bit of maybe we'll run through this case study that we found. Thank you to DBA lawyers, an SMSF legal specialist. No, it's not a sponsor of the show or anything, just a really good example. Because the alternative is to take money out of super and invest it somewhere else. And the answer to most of those questions as to what to do is it depends. It's going to depend exactly what your situation is, what your tax position is outside of superannuation, and what your priority is. This example, maybe I'll run through the intro, and you can you could tell us the outcomes of each one. So there's a worked example that looked at the comparison of tax rates holding a significant property in different entity structures. So it's very simple. $5 million property produces 3% income per annum, and an increase in value by 7% per annum. It's owned for 10 years and then sold under assuming the current CGT regime, including Div 296. So maybe what does the tax payment look like? I don't think we had a cost base there, did we? No, it's purchasing a $5 million asset at the beginning. Yeah. So you've held it for 10 years. You've assumed 10% return essentially for 10 years.
I really love this worked example because I think it's just set out well. This will be included in the show notes, so feel free to have a look. But the basic modelling here is that if you just bought this asset in your own name and you held it for the 10 years and then you sold it, it's expected because, of course, the capital gain would be so big that you're going to be at 47% tax pretty quickly. So the tax rate that you're going to pay here is about 31% overall.
2.1 million.
2.1 mil of tax. Now, if we go to, by extension of that, if we bought that was bought and then sold outside of the SMSF, but there's no other income, so it's zero. It's zero. So you're not already starting at 47%.
70s for some, let's say.
Then the tax rate is 26%. So you end up paying 1.8 mil of tax. So that's probably thinking about a retiree or someone who's held it for many years and saying, do I buy this in super or personally? That's probably a realistic number. Then scenario 2 is what about if you bought it through the self-managed superannuation fund, but it's not in pension mode, it's just in 100% accumulation mode. The total tax you pay is 1.4 mil. So still better off holding it inside the super environment given current legislation.
By $700,000 or from having no income, $400,000 better off.
And then the scenario 3 is it's bought and sold inside of the super fund, but we've got the maximum amount in pension mode and the remainder in accumulation. And under that model, the total tax is 1.1 mil.
So there's $1 million difference between you're already on the top marginal tax rate and you're holding it through superannuation.
Yeah. There's also a $1.1 million difference between the legislation today versus proposal versus 2016. So it speaks to the fact that for people with high incomes, that it has been quite penalising. High super balances. There has been a real penalty over the last decade in terms of the changes that have been made to super if you're looking to sell big assets. Yeah,
and I think the key takeaway there is it's just reiterating that regardless of this change, superannuation is still going to be better than holding it directly for these large assets and for those with larger wealth, like high levels of wealth.
Correct, yeah. If you've got the ability to be, if you're a pre-retiree or even a retiree and you've got the ability to be able to purchase these assets in super or purchase them in your own name, if tax is the number one priority, which in a lot of cases it will be, if tax is the focus, then there's a lot to be said for not buying it in your own name.
And if you had any recommendation for people listening?
Well, we'll do our best to keep you updated, but I mean, this is a proposal right now. So if you feel that this is something that could affect you, the number one thing that I can recommend is you need to be across this. You need to be following it to the point where if it is legislated and there are developments there, then you need to know how it's going to affect you. So hopefully you've got the right professionals around you to be able to point that out for you. If you don't have those professionals, then this is something that you need to keep a sharp eye on. What about for you, mate? I'm going to drop you in the same hole that you dropped me.
Yeah, my advice with this one is do nothing. Like just wait for clarity and then you'll have plenty of time to adjust. And then second, seek advice. If you're in this position, you might think the cost of advice for this might be expensive, but you can see from that case study what the potential benefit and the tax benefit is of getting that advice if you get it right.
Mm-hmm. Well, thank you so much for a terrific session, Drew. And thank you all listeners for getting along for this one. Now, again, as a reminder, please, if you have the opportunity, please like and subscribe, because that's going to allow us to continue to grow this podcast as best we can. But from our end, thank you, and we will see you next Thursday.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.